I'm sure you're as glad as me. This is the last of the four videos on the mocks you've just taken, the Jan 17 ones. Paper two, last three questions. First question was a suspense account question. First, make sure you read all the information, make sure you read it carefully. The shortage is on the debit side, so therefore the opening balance should be on the debit side. Okay, it goes on the short side, the side that's got less on in the suspense account from the trial balance. The total of a page of the purchase account had been carried forward as 3824. So there's a difference in there of 18. Okay, and it must have been, and it needs to be bigger. So we would debit purchases, credit suspense account. So it should be on the credit side. Yes, it is. Okay, a check received from DECA Limited for 150 is being credited to the account of DDE Limited. Well, we debit bank credit the customer normally. So the only error there is it's been put in the wrong customer's account. So therefore it won't appear in a suspense account because it's an error of commission. The balance of the petty cash book, $100, has been omitted from the trial balance. So we need to debit the cash or petty cash and credit the suspense account, being done correctly. Repairs to motor vehicle have been debited to the motor vehicles account. So that one there is straight away, that's an error of principle. It's in the wrong type of account. That's not going to affect it. Purchases of fixtures of 2,200 on credit from office supplies have been debited to the office supplies account and credited to the fixtures account. That one's a complete reversal of entry. So when you correct it, you'd need to double the correction, but it isn't going to affect the suspense account. The total of the discount allowed column in the cash book is being credited to the discount received account. Right, so the first thing we're going to need to do for that one is debit discount received, credit suspense account. So there'll need to be 250 on the credit side of the suspense account. And then what they should have done is they should have debited discounts allowed. So we debit discounts allowed, credit the suspense account, and therefore, hopefully looking at the answer, there are two entries of 250 in the suspense account. Thinking back to Thursday when I marked it, quite a few of you'd only got one entry in there. And then I'm going to cheat here and look at the other entries, the 67 on the credit side. So what was that for? The total analysis columns for the stationery and the petty cash book of $67 has not been transferred to the stationery account. Thinking back to what we did on the very first question on paper two, when I went through that, it's the totals and they would have got debited to the stationery account. The debit entry is being missed off, so you need to debit stationery and therefore credit the suspense account. And what was a little bit strange about this question was that then the actual account didn't balance off. We haven't found all the errors, and therefore there's a balance carried forward, balance brought forward of $190. I think we went through that when we actually talked about the question at the start. So I'll kind of skip that. You can just pause it and have a quick look at the three possible entries to correct the errors that don't affect the trial balance. Don't forget you need to have some kind of commentary to get the full marks. It says so in the question. And question C was name the error number 2. Number 2 was an error of commission. It's in the wrong type of account, the wrong account, but not the wrong type of account. And then there's a bit of a standalone question about which ones affect profit and which ones don't affect profit. So if we go through them and the reasons why they affect the profit, the first one is going to affect the profit without a doubt because we need to change purchases, and purchases appear in the income statement, not in the statement of financial position. Second one isn't going to affect the profit at all. It's just in the wrong type of account. So it's just going to affect which which one of the customers owe the business money. The balance of the petty cash book has been omitted. That isn't going to affect it because petty cash is an asset, and the only other thing that was affected was the suspense account. Repairs to motor vehicles is going to affect it because it's being debited to the motor vehicles account. So we're going to increase an expense when we take it out of the motor vehicles account, which appears in the statement of financial position. Purchase of fixtures, that's number 5, isn't going to affect it because both the fixtures and the office supplies limited, which is a liability, appear in the statement of financial position. 6 will affect it definitely because both the accounts that are affected, discounts allowed and discounts received, appear in the income statement, and furthermore, because both of them are getting debited, it isn't like the two cancel off, which can happen sometimes. So if we'd have debited the discount received rather than crediting it, we'd have ended up doing a credit entry and discount received, debit entry and discount allowed. That would have had no impact on profit because you've got both a debit and a credit entry going into the income statement. And 7's got to affect it because we've got to increase our stationery. That's an expense and appears in the income statement. Right, moving on to question number 5. I'm just going to pause it very briefly while I'm recording because I've forgotten what question 5 was. Right, question 5. While I quick look at it, it's quite straightforward. You were told what the opening provision was. Provision's got a R in it, goes on the right hand side, or the credit side. Credit has an R in it, so whatever way, the 474 goes on the credit side. And the credit customers owed the business 17,440 at the end of the period, and there was no bad debts in there, so 2.5% of 17,440 would give you 436. So what's happened is there's been a decrease this time in the total amount of provision for bad and doubtful debts. So there's an entry on the debit side that goes to the income statement, and then you're asked to do an extract. The extract is going to be because you were just asked to do the statement of financial position, you'll have the trade receivables at the start, less a provision for doubtful debts of 436, which is the year-end balance. A few of you tried to add them together. The balance carried forward is the amount of provision in the accounts, and then from there you get the closing balance. I think nearly everybody got this right. Provision is what you anticipate you'll lose from your trade receivables because of bad debts, whereas a bad debt itself is an amount that actually you're not going to get paid for. We do it to ensure the profit for the year is not overstated and that the trade receivables are not overstated. The other concept that's involved is I think that was a question. Is the accruals or matching concept. And then this was well done. There's a whole list here. You can just pause it and read through them of ways that we could reduce the amount of bad debts. They were straightforward. Well done. And then the final question on there was for a bad debt recovered. The more correct way of doing it is this alternative way, where what we do is we recreate the customer, if you like. So we receive the money, we debit bank, we credit Khan, and then we debit Khan and credit bad debts recovered. But it was also accepted by the exam board if you just went straight for bad debts recovered or a credit entry and you debit the bank. And you've got to put in there some kind of a commentary. This way is technically better because what it does, and you can see what's happened in the books of Khan. If you do this, there's no entry in Khan's books, and therefore if you're looking back through the books in the future, you will not know that there's been this bad debt issue. Okay, last question. I thought this was quite an easy question, Most of you got full marks, 1 or 2 of you didn't. So those of you that didn't need to pay attention still. Okay, 33% as a percentage of 220 is 15%. So the section 1 there should have been 15%. We then do list price, take away the discount, gives you the actual amount the customer is going to get charged. So 220 minus 33 is $187. And then you would add 187.30 to get 217. That would give you the total amount on the credit note. That would be the amount that the supplier was going to reduce the customer's the amount the customer owes them by because of these returns. Person who issued it was J Kapoor. Loads of possible reasons. It could have been an overcharge, but it's more likely to have been either just good return and be accepted, or the return of faulty or damaged goods. The request for the credit note comes on the debit note, and then the tables in here, what we should have done is we should have debited sales returns and J Kapoor's book, because J Kapoor is getting the inventory, which is an asset, back in again, and he would credit Vijay Singh, because Vijay Singh now is a smaller asset, or we're reducing the asset of being owed money. But for Vijay Singh, he would debit J Kapoor's account because he's reducing the amount of liability that he owes to J Kapoor, and for him it would be the purchase returns, which is on the credit side, the opposite side to purchases. So if you know your purchases are debit, you credit purchase returns, or you credit purchase returns because you've actually sent the goods out. And then a lot of people put quite a lot of things in the sales ledger control account they shouldn't have done, or the total trade receivables accounts, it can also be called. Remember, cash sales don't go in. And you've got discounts received don't go in. That was about it, really. And some people struggled with this, but I'll go through this 21 when we look at the answer. Looking at the answer, balance brought forward on the debit side because it's money owed to Vijay Singh, it's an asset. The sales go on the debit side because that increases the amount of money that Vijay Singh is owed. The sales returns go on the credit side because it reduces the amount of Vijay Singh's asset being owed money, as does the bank. That explains why the dishonored checks on the debit side. It's included in that bank figure, and therefore it's got to get, if you like, go on the opposite side to cancel it out. You've got the discount allowed, reduces the amount of money that Vijay Singh is going to collect. The contra, where a customer is also a supplier, and therefore you write off part of the debt that one owes the other, and then just one of the either Vijay or his customer would send the balancing amount as a check. That goes on the credit side because in the sales ledger control account, we're reducing the amount of money owed. And the interest is a debit entry because it's interest received by Vijay Singh. So he'd credit his interest received account because it's an income. He would debit the customer, and it increases the amount of money he's going to be owed. You've then got the balance that I spoke about. You've got a credit balance on the sales ledger control account. Remember, it means it's a credit balance brought forward. So therefore, the balance carried forward is on the debit side. Balance off the accounts. Work out the total amount that Vijay Singh is owed at the end, which is 492. Balance brought forward 492. There's an explanation. This was generally pretty well done, the contra. And what was that question to do with? Oh yeah, everybody got this right. Why did they charge a credit customer interest? Because they hadn't paid them on time. And then two big reasons for doing a monthly sales ledger control account. One is it helps you to find errors. And the second one is also helps to prevent fraud because you're looking at the information coming from the basic basic source. So reasons for doing sales ledger control account, system location of errors, instantaneously find out how much money the business is actually owed. So if you want to do a quick statement of financial position, for example, that's useful. Checks arithmetical accuracy in the sales ledger, because if the individual customer accounts aren't added up correctly, there will be a different when you add together all the amounts owed to the business by the customers and the amount that comes off the sales ledger control account. And it provides a summary of all the transactions, but the big one is it helps to reduce fraud as well. And the reason why we don't take any of the information out of the ledger itself, we go back to the books of prime entry, is it won't help us to find out if there's a fraud being committed by an accountant, because if I go and use the figures that the accountants put into the ledger accounts or into the computerized system, if I do it that way, then all I might be doing is checking that his fraud has been recorded. So I go back to the books of prime entry, because that way I'm looking at the work that somebody else has done, for example, the salesman when they made the sale, and I'm using the total figures from all the books of prime entry to make sure that they match the figures that go into the sales ledger control account. So if I don't go back and use that original entry information, I won't know if there's any fraud, and I won't know if there's been any errors. Right, that's it. You'll be glad to know.